Dream big, plan smart, build wealth. This is the TFS podcast, where money talk gets real and financial freedom is more than just a goal. Without further ado, let's dive in.
Welcome to TFS WealthCast. Today, we are going to talk about a matter that one of our listeners have sent to us, asking a question and also asking an advice what they should do. So let me read this question before, and then I will introduce who's going to be joining to this episode. I've got a mortgage of $750,000, and my house was recently valued at $850,000, giving me equity of $100,000. I have a LVR of 85%. I recently sold an asset overseas and will be getting 250,000 Australian dollars. My objectives are build a portfolio so that I can retire comfortably in 20 to 25 years, pay off my current home loan ASAP. How best can I invest the 250,000 to get the best possible return? Put part of it towards my current mortgage and reduce my LVR, or less than 80% and invest the rest and buy 1 to 2 other properties. Number 2, he's asking, invest the full 250,000 and buy other properties. Number 3, put the full 250,000 to my current mortgage and bring it down as much as possible. And then he has also asked any other option I have not thought of, ? So today I've got Sonali Rodrigo, none other than our financial planner and COO at TFS, joining me. So Sonali, welcome.
Thank you.
Okay, so Sonali, now you heard this email from our client, but before that, let's get into few questions. Let's go and iron out some of the most important things that some of our listeners may or may not still know. Understanding LVR and mortgage fundamentals. So, Sonali, what is this loan to value ratio, LVR? What is it?
So LVR stands for loan to value ratio. So if you say, I'll use an example to illustrate the point. So let's say that we have a property that is worth $1 million, and then your loan is $800,000. Then you take your loan, divide it by the property value, times it by 100, and that will give you your LVR. So essentially, if you have $800,000 of debt against a $1 million property, your LVR will be 80%. So usually lenders like borrowers whose LVR is 80% or less because they consider that to be a less risky borrower. You may have heard the term LMI. That stands for Lender's Mortgage Insurance. So anytime your LVR exceeds 80%, the lender goes, oh, you guys are a little bit too risky. We need to go and take out an insurance policy to make sure that, in case you don't pay, that we have some recourse. So therefore, here's the premium. You pay that because you're the risky one. So you pay that and cover the cost for the lender. So essentially, anytime you borrow above 80%, most of the time, you have to pay lender's mortgage insurance because you're considered a risky borrower. There are some exceptions to this rule. There are professional LMI waivers, so people like doctors, accountants, there are lots of other professions. Lawyers,
nurses.
Yeah, so there's lots of professions that get these LMI waivers. You get to borrow up to 90% without LMI. And then you guys may have seen in the news recently, you can borrow up to 95% without any LMI if you're a first home buyer, because now the government guarantees the loan for the lender, so they don't have to go and get this lender's mortgage insurance. So therefore, there are, various exceptions to this rule. But in general terms, if you borrow above 80%, you have to pay LMI.
Okay.
Yeah.
Okay. So that very important for us to understand what is this LVR and LMI is, because these are the two terms that we will be using when it comes to property investment and restructuring your debts, reinvesting, building portfolios. All right. So let's get on to this customer's or this listener. I would say this listener's first question, right? Question number one, he wants to know, paying down the mortgage to 80%. Do you think it's a wise idea to bring down? I mean, it's about a 5%. That according to his valuation, that's about 5%. But I'm pretty sure the valuation could be a bit more than what he sees it in internet.
To be really honest, I don't see too much of benefit paying down the LVR, because if you already have a mortgage above 80%, chances are you've already paid the lender's mortgage insurance. So even if you pay down, typically if you've gone above the 1 year mark, you won't get any refund. And even if you do get a refund, it's really not substantial enough to, amount to too much. So I wouldn't use the money to pay down the debt, to be really honest.
No. Okay.
I'd rather use it towards something else that might, make it work a bit harder than that for me.
Okay. So you wouldn't necessarily go down the path of just putting the money and reducing the loan for the sake of it?
Not to bring down the LVR.
Okay.
Yeah, because that really doesn't do too much. You've already paid the LMI. I mean,
it doesn't make sense.
It doesn't make sense just to, you're not, if it makes you feel better or helps you sleep at night that you're at 80% LVR, yes, okay. But, how many of us need that? 85 to 80% is really not a big deal, I don't think.
Yeah. But some could argue, because bringing down the LVR to 80%, you can get low interest rates from banks.
That is true, but there are better ways to get lower interest rates. Like you said, it might be 85% based on the information you see on the internet. But if you actually, get a broker to revalue your property, you might be at 80% anyway. So
the market might give you a better valuation than what you think. Yeah.
Especially considering now the rates are on their way down, property values are on their way up. So chances are you'd get a better valuation and you'll be at 80% anyway. So if it is a cheaper rate that you're after, yes, you would get a cheaper rate at your 80% LVR as opposed to 85%. But there are other ways to kind of get it lowered. You can even consider refinancing even at 85%. Some of the lenders do no LMI, depending on the client's profession. We might get an LMI waiver. So there's lots of things that we can look at. Yeah.
So coming down to his other second one, pay off my current home loan as soon as possible, ASAP. So what he's thinking is, you use the $250,000, put it to the
offset account,
home loan or offset account, bring down the interest paying component to $500,000.
So
would that help him to pay down his home loan in a quick manner?
Yeah, definitely it would. Rather than paying it into the loan, if it was me, I would put it into an offset account, so that it offsets the loan balance and then saves you interest over the longer term, as opposed to putting it into the loan and then bringing the limit down. Then that money is not easily accessible if you need it.
If you put the money into the loan.
If you put the money into the loan
Yeah.
and then you adjust.
Yeah. Like a even if you put it as a lot of customers do this. They put extra money into the loan and keep it as a redraw.
Keeping it as a redraw is okay.
Yeah.
Then you can have access. But there are
Yeah.
some customers who put it into the loan and you reduce the limit.
Yeah.
If you reduce the limit, that means you're telling the bank to pay it off. So
Yeah.
if you need that money again,
You have to reapply.
You have to reapply and
Yeah.
go through the credit process. So then, you may or may not qualify, but then it's a process again. Whereas if you put it into an offset account, or even redraw, you can take it out again if needed. If a portion is needed, you can just access that. So that will save you interest at the loan interest rate, basically. It's almost like a guaranteed return almost. And a tax-free return, essentially, because you don't really have to pay tax on that interest saving.
Only thing in Australia that is tax-free, in my opinion. Your own home, you create equity. In about a few years' time, if you sell it, you get that money to yourself. It's like that's the only thing that is tax-free. Is it right? Is a tax winning a lottery is tax-free, Sonali?
Don't ask me tax stuff.
It's paying down the home loan using the money. It's actually not bad if you don't want to go down the path of reapplying, access the equity, buy investment property, this and that. You want to just focus on paying down the home loan only. Yes, use the 250,000, pay it down, or keep it in an offset account. Start paying the principal. So you reduce the term of the loan.
Yeah. So, even there, if you keep it in the offset account, it outperforms most term deposits nowadays, right?
Yeah.
Term deposits give you 3.5, 3.9, 4% maybe. So that's still better than putting it into a term deposit.
Yeah.
Where you would pay tax on the
gain
that you get there, the income that you get there. So this is better than doing that. But there are far better ways to use that money, I think, while still achieving the objective of paying down the mortgage quicker.
Yeah. So why do in your industry as a financial planner, I know for a fact that there's two types of debts in Australia, right? So you have good debt and then you have a bad debt. Could you explain about this to our listeners? What is a good debt? What is a bad debt?
Okay, so simply put, we call it good debt and bad debt, but the technical term is non-deductible debt is bad debt and deductible debt is good debt. So if you let's say your home loan, for example, that is not an income producing asset. So then that is technically termed a bad debt because the interest that you pay on that owner-occupied home loan is not tax deductible. You can't deduct it from your income tax and pay less tax. Whereas the ATO allows you, if you borrow to buy an income producing asset, the interest that you pay on that loan, that borrowing, you can reduce it from your taxable income. So that is called a deductible debt, which is what we term a good debt. So the objective for a lot of people is to reduce non-deductible debt and then, convert it to good debt, which are income producing, capital appreciating assets.
Okay.
Yeah.
Okay. So in this case here, how would you advise this customer to use this 250,000 that he's getting in the best possible manner that help him to be financially free? So that's what he's asking, right? He build a portfolio so that I can retire comfortably in 20 to 25 years. It's not unrealistic here. 20 to 25 years is a very good amount of time. How would you use this 250,000 in a situation like this? What would be your first move?
my first move right now is to say, if this person is listening, I really need to sit down with you further before you act on anything that I say. I just want to sort of give some options and what you can think about. Then you can decide, what suits you, and then apply that. Or we can have a proper sit down chat and then go through it.
Absolutely. So we are using this as a example for you, the listener who sent us
this is general
question.
advice only,
Yeah.
and it is not personal financial advice.
Absolutely. And then also for the other listeners, if you're in a situation like this is something that you can think. This is a opportunity for you all to now start thinking. If you have the money, what you should be doing with it. So Sonali, $250,000. What would you do now in this situation?
So I would pay down his non-deductible debt, which is his home loan, by $250,000.
So that means the loan comes down to $500,000.
Yes. So from $750,000, it would come down to $500,000. I would set up a separate investment loan facility, borrow that back out again, the same $250,000. So you're essentially left with the $750,000 debt. So you need to get your head around the fact that, you'll be left with the same level of debt, but we've changed the clothes essentially. Previously, it was non-deductible debt, but now $250,000 suddenly became a deductible debt. So the interest portion on that will be tax deductible if you use that $250,000 to buy an income-producing asset. Now, what is the income-producing asset you want to buy? That depends on your risk tolerance. You could possibly put it into like Australian dividend-paying shares, exchange-traded funds, managed funds. You could buy an investment property with it. So as long as it produces income. And then what you could do also is, let's say you invest into Australian dividend-paying shares or exchange-traded funds. That would pay a dividend probably twice a year. So when you get that dividend, you can put that against your home loan again. So use the income and then keep paying off your non-deductible debt. So then you end up paying your home loan faster. However, when compared to if you just went off and paid off your home loan, you're paying your home loan off, but you also have an appreciating asset, an income producing asset as well. So you almost get the best of both worlds when you do that. But the thing to do is you have to get your head around how these things work. Because for some people, they might want the peace of mind knowing, my home loan is paid off and I don't have to worry about it again. Right? So it depends on each person's risk tolerance. You can't just have a one-size-fits-all thing, because every one of us feels differently about money anyway, and debt. And it depends on our upbringing, how we were exposed to money as kids, our experiences, all of that shapes, how we act around it. So, for some people, debt is like, oh my God, no, I can't sleep if I have debt. So, for those sorts of people, yes, you might go and just reduce your debt, and that's fine. But once you educate yourself around these things, you'll start to slowly learn how it works, what's good debt, what's bad debt. That good debt might not be as bad as people think it is. In the end, over the long term, you would end up with quite a good portfolio and a good platform for retirement.
So this, I know that a lot of people call this debt recycling. What you just explained. Right? So you put your 250, bring down the home loan to 500, and then you take this 250 back or slightly lower, maybe about 200,000, you take it back. It's about 170,000 up to 80%. We stick with 850,000 valuation, right? 80% of that is 680. Is that right? See, my calculations are correct.
680, yeah.
680. So you brought down your home loan to 500,000. You're taking an equity loan or an investment loan from the bank of $180,000 to reinvest
Yes.
into a property or shares. What can they do with 180,000, Sonali? What can
so
they
now
do?
you paid down 250 and you're borrowing only 180 back. That is if you keep your LVR at 80%. Now, if this is someone who qualifies for the LMI waivers, we could borrow up to 90% back. So
As a
then,
professional.
as a
If you're a
professional,
doctor, if you're a nurse, or
There are
doctors, you
like
can
a
go up to
whole list.
97%, I think.
there's like a
Right?
whole list of
As far as I can
professions
remember,
that
there are,
qualify. So you can
Yeah.
depending on
Yeah.
what it is without paying LMI.
If you don't mind sharing these professions who can go up to 90%, right? Just whatever that you can remember. It's good for listeners who are listening to this. They may not even know that they would be qualified for this.
Yeah, just off the top of my head, doctors, nurses, accountants, lawyers, physio, vet, dentist. Like there's a lot.
Vets as well.
Yeah, with
wow,
some
okay.
vets,
Okay, there you go.
vets as well. So they qualify for special, medical options as well.
Yeah.
So yeah.
So that's a lot of that lot of professions, right? And so professionals, if you guys are listening, and if you're in those kind of professions, there you go. Up to 90% you can borrow. You don't need to pay lender's mortgage insurance.
I do want to say something controversial though. So LMI is not all bad either, right? There are certain situations where just paying that is fine. Because to be honest, if you're borrowing to buy an income producing asset, LMI is also tax deductible. Not straight away over a period of 5 years, but that's also tax deductible.
Over 5 years is tax deductible.
Yeah. So it's you have to weigh up the pros and cons and decide on a case by case basis whether you go do the LMI or not. But yeah, it's not always, let's avoid LMI at all costs. It depends on your situation. There are instances where we've asked customers to, pay LMI. That's fine because it achieves the objective of what they want to do at that minute. So, yeah, I just wanted to say that. We've paid LMI before for some of our own loans.
We paid LMI quite a lot of times, I believe, as far as I can remember.
Because we were very confident that what we were going to do with the extra money was going to be like,
it's an opportunity cost.
So it was completely fine for us to pay that. So, but since, my favorite lender introduced no LMI for my profession, we stopped playing LMI, but we paid that before as well. So
we're pretty much taking the LMI to ourselves now and we're investing it.
So I just wanted to say that. So sorry, you were asking me what are the things they could do with the money that they borrow. It depends on.
So in this case, this client can borrow 180 up to 80%, no LMI.
Yeah,
you don't pay LMI, but you got $180,000 now. Recycle the cash, what you had. Right. So which was non-tax deductible
before, but
now it's become a tax deductible.
Yes.
Right. So there's more. So what can he do? What can he do?
He can go and invest in shares.
And what sort of returns you reckon in very average? I mean, you don't have
average returns are between 8 to 10%
per annum. 8 to 10%. Okay.
Yeah, but then depending on the type of share you buy, there would be an income return as well. But I do have to say shares are quite volatile, so you have to look at it over the long term. It's about 8 to 10%. So I don't want to say for every year it goes up 8 to 10%. It doesn't. It can go up and down. But typically, if you buy a good blue chip stock, you would get about 4 to 5% dividend yield. So that is income producing as well. So then you can use that to pay off your home loan while you wait for the capital appreciation that comes with shares over the long term.
This is all comes with the risk appetite and your risk profile, right?
Definitely.
I mean, I'm thinking it's 180,000. You could possibly buy a business.
Yeah. you can buy
and,
business.
and create more income for
Yes,
yourself.
but you have to be very careful because
Yeah.
not everybody knows how to go about running a business
Yeah.
or even how to, look at a business to buy. So
Yeah.
that is for a very limited number of
Yeah.
people that I would advise to go buy a business.
So, if you're a sophisticated investor,
Yes, definitely.
you can go down the path,
Oh,
or you
yeah.
can invest in a venture capital
Yeah, of
fund,
course.
right?
Definitely.
Am I
Yes,
making
correct.
sense here?
Yeah.
Right.
But again, like I said, because we have to be very conscious of the sort of background knowledge and experience that's required to do those sorts of investments. So it's not suitable for everyone. So even shares, same thing, depends on your knowledge around these things and your risk appetite.
Yeah.
You can do managed funds. Managed funds.
Can I ask a question on that? Can they also go and invest in cryptocurrencies here? I mean, I know there's quite a lot of people.
Can.
Yeah, you can. And
But-
it is also in Australia. It is now you have to pay tax for it, right? Your gains. But I've heard, I don't know, I've read it somewhere. I think you have to pay tax for your gains.
I shall not comment on crypto.
Okay, there you go. So I'm getting carried away. So I in my head there's 180,000. How can I invest for this client? And my head is just running like crazy. Now, okay, right. So we talked about the asset classes like these. What about property, bricks and mortar? You and I have done this. Very
so
comfortable
the
there.
beauty of bricks and mortar is now, like I think I explained this in one of the other episodes that we did. So if you invest in shares, unless you do something called margin lending, where you borrow against that, you're essentially investing the 180,000 that he took out as an investment split from the home loan, right? But if you invest in an investment property, you use the 180,000 as a deposit. You borrow further 80%, let's say, from the bank, and then you buy an asset that is worth far more. So you use the 180 as your 20% deposit plus cost, stamp duty, all legal costs and stuff like that. And then you buy an asset that will give you rental income and then will also give you capital appreciation over the long run. But then the capital appreciation is not just on the 180, it's on the full property. So you get the benefits of, it's leverage. It leverages it. And then you get the return on the full 100% there. So that always ends up being a winner over the long term if you buy well.
Absolutely, right?
Majority of the time. Yeah.
Income generative.
Yeah. And then plus you get tax deductions, further tax deductions there as well.
Capital growth that you can again leverage and do the same thing if
there's
you're smart.
Depreciation benefits that you can get as well. So there's quite a few things there that
list goes on.
Yeah. So
he can with $180,000, right, at a very level, very I would say, without paying lender's mortgage insurance, just borrow back again.
Just off the top of my head, he can buy something for about 650 to 700,000 easily.
Establish property, pay stamp duty. Is that right?
It depends what you want to do. Like if it's something that's in a good area, you can do a house and land or whatever it is that they want to do. It's up to them. But 180,000 is more than enough to do that.
I think so. I think it's way more than enough. I think we have done, I remember a portfolio we started with a 180 or 170,000 that we created about 4 property portfolio within 2 years from the 180. Because we started leveraging back again.
Yeah.
Right. So there are quite a lot of ways that you can recycle the debt as well. It's not just recycling for the sake of it. There are so many other avenues and so many other ways that you can keep recycling the debt to get more benefits for yourself. And if you ask successful property investors or successful individuals who have done the correct way of investing and building larger property portfolios, sustainable share portfolios, they have always leveraged, and one of the common thing that they have is that. And also one of the common things they have is they have a group of people who understand these investments, who understand how to access the equity, how to recycle the debt, how to maximize the tax deductions, and keep investing and building the portfolio. You can't just do it. You can't just go and ask somebody, okay, you just give me $180,000 loan.
No,
And
so see, one of the
doesn't work
things
that way, right?
most of the time people hit a borrowing capacity ceiling at one point, right? So you need to know how to structure it in such a way
Yeah.
that you can continue to do that.
So there are so many ways this 250 can be used.
Yes.
Right? You don't even need to necessarily have to put it to the loan and recycle this debt and start investing as well. You could possibly start using this 250 as your capital investment to different kinds of properties under trust, right? So, but these are complex way of investing. These are different strategies. You can do that because end of the day, you're not going to get a personal tax deduction, when you go and invest in a property through a trust.
No.
So you can invest your capital to a trust and start acquiring properties as well if you want to. So it is always up to you, I believe, right? And how you want to do it. What do you think, Sonali?
Yeah, see, it's a fine balance. It's on a case by case basis. Like I always say, it depends on your income. It depends on what are the benefits of investing in your personal name versus under another structure. Should we maximize what's in the personal name? How would it affect borrowing? There's a lot of things to consider when you're doing that. So yeah, that's a whole another episode.
Yeah, it is. So guys, we covered quite a lot here. I believe we've given the bit of information for our listeners what he could do with this 250,000. Like Sonali said, if you're listening, it is time to give us a call, and we'll set up a time, discuss, and come up with the right plan, and the a plan that customized for yourself, right?
Yeah, because it depends on the risk tolerance, cash flow comfort, the investment time horizon, whether you're conservative, aggressive, or whether we do a mix of both.
Yeah.
Like maybe, half or whatever it is. So that depends on a whole host of other factors, like, what's his income, what are his other, debts. Does he have any other debts? What does the partner do? What's her income? How do we then structure it? What's the ownership like going to be? This whole lot.
There's a whole lot. I mean, is. I mean, we can talk about the whole episode about this. The areas you have to consider. Now, we have to wrap it up. I believe it's a very good episode for a lot of people, not just this particular listener who sent this question and the concern, I invite you all who's listening, send us the questions. Send us what are the things that you like to do, and the ways that you think that you could invest, or you could how you could increase your portfolios. Please do share your story as well with us, because your story could inspire quite a lot of other people as well as us to do certain things. So I welcome you all to send your questions, send your concerns, send your strategies to us. We would love to see them. So
I think one of the main reasons we started doing this was because we started to understand it might inspire a lot of people. So it's actually worth it. So send it in. Where do they send it into?
We have an email in our podcast, so you can obviously send that to that email itself, or you can visit our website, which is Tomorrow Financial Solutions. It's actually not the website, so guys, I'm so sorry. It's tomorrowfs.com.au. right? You can visit our website, or you can Google us saying Tomorrow Financial Solutions. We will pop up. Send us a message. Say, look, we've been listening to the podcast. We want to, say whatever you want. We will never judge you. But if you want to ask certain questions, please do. Please do
Don't
send.
be too critical.
No, it's okay. Sometimes I like that.
That's you.
Uh,
Speak for yourself.
Right, guys. I do like it. So if you want to be critical, because that will help me to grow this podcast, to go and achieve, or go and reach more people, and give more advice to a lot of other people, to inspire them to invest, and so it will inspire a lot of other people as well. So I'm looking forward to this questions and concerns, and strategy sharing, knowledge sharing. I'm looking forward from our listeners. So please do get in touch with us. So thank you all for listening. And Sonali, thank you for your time. Thank you for explaining these strategies. So much of information. Behalf of everybody, I like to say thank you.
You're
So
welcome.
looking forward for the next episode. Stay tuned, guys, and please subscribe. Please share whatever you think that you like in our podcast, so this can go to a lot of other people. Thank you. Until next time, take care.
Thank you for tuning in to another episode of the TFS podcast, where we turn knowledge into action and big goals into real results. Now, don't forget to like and subscribe and share this episode with someone working towards their next financial step. Now, with that being said, until next time, keep building.